So my subject today is the art of investing. Hari told me that people in Thailand and people in the audience have much higher IQ than I have, right? So I have tried to keep it extremely simple, right? This is what I am good at, right? I combine my average skills in investing with average skills in communicating, with average skills in illustrating, and that is what I have in front of you. And that's the reason I call it the art of investing. I'm going to talk about why I call the art of investing. And as Hari said, the secret of happiness is to have very low expectations. And this is also what I expect of you, that you don't have very high expectations from what I am going to talk about today, so that by the end of it, you're much happier than if you had, or if you start with high expectations, right? So keep your expectations lower. Nothing fancy that I'm going to talk about, especially people wearing suits, right? There's nothing complex that I'm going to talk about. I'm going to keep it extremely simple. He gave me a broader idea of the kind of audience that I'm going to see in this room today. And that's the reason I am going to try to keep it extremely simple. It does not mean that you guys have low IQ, right? As Einstein said, the highest level of intelligence is simplicity, right? And that's exactly why I try to keep it simple. Jean Cocteau said, art is science made clear. So art is the bridge that connects science with everyday living, right? So investing, we all understand, is part art and part science. When you start investing as a career or as an investor, you think it's science. When you start investing as a career or as an investor, you think it's science. It's a lot of maths, right? A lot of numbers, a lot of complex stuff. But as you grow as an investor, you realize it's more of an art. It's largely based on intuition. Of course, there are numbers that you need to study. Of course, you need to study sometime balance sheets, the annual reports, the financial statements. That's a complex part, right? But it's art because it's largely about how we behave, right? It's a very personal thing. Investing for you may mean something else compared to what investing means to me. And Henry Ward Beecher said, every artist dips his brush in his own soul and paints his own nature into his pictures. So what I am going to try and talk today, and what I try and talk across all my courses and sessions, is what I really believe in and what I really practice, right? So everything that I'm going to talk about today, including the illustrations, I've done it all myself, right? But everything that I'm going to talk about today is what I personally practice, and there's nothing complex that you're going to see that I practice as an investor or as a decision maker. Another reason I try to keep it very simple is because I really believe in this technique called the Feynman technique. The Feynman technique is after Richard Feynman, who was called the next Albert Einstein. He was as smart as Einstein. And the technique simply means that if you want to really learn something in life, including investing, you should first study the literature which is all around, and then you should try to teach a young child, a 15-year-old or a 10-year-old, what you've learned. If you're able to convince him or her, and that the child is able to understand what you're saying, it means that you've learned it. If not, you have to go back to the literature and relearn it, right? And since I'm using a lot of illustrations, a lot of pictures, a lot of simple language in terms of explaining you the ideas, this is the technique which I am following today, Feynman technique. I follow this person called Thich Nhat Hanh, who was a Vietnamese scholar and monk. And he said that for things to reveal themselves to us, we need to be ready to abandon our views about them. A lot of times, a lot of us come to a session like this, or anywhere we go where we want to learn something, a lot of times we come with a lot of preconceived notions of what this session may be, right? Or what this, for example, as far as investing, a lot of people come with the idea that it's going to be complex stuff. It's going to be stuff about maths, investing, how to pick stocks, right? My idea is, when I start this session, as I said, is I would like you to be ready to abandon what you already come with, right? Be willing to listen to me with an open mind, right? As they say, it's only when the cup is empty that new knowledge can pour into it. So that's my idea of what Thich Nhat Hanh says. Can anyone tell me what this is? This looks like a beautiful night sky, right? This is actually a stock price chart of a company called Asian Paints in India, right? And that has compounded shareholder capital over many. So you can see the illustrations, right? So I try to communicate everything through illustrations. It makes it easier, and you're able to remember the stuff that I'm talking about. So this is the stock price chart of Asian Paints and how the stock has compounded wealth over many years. Now, what is this? Thai stocks. or a stock that has lost a lot of value to shareholders. In fact, this is nothing. This is just a random drawing, right? Now, the first lesson of investing is that we should not draw patterns from the past. Just because the previous slide was about a stock price chart does not mean that this is about a losing stock. A lot of times in investing, if we are in a bull market or if in a market which is rising, we all paint a very rosy picture for the future, and we think that what has happened in the recent past is going to happen in the coming future as well, which is not always the case, or not often the case, because markets always move in cycles, right? We have a good market followed by a bad market, and we have a bad market followed by a good market. When my daughter was 11 years of age, I wanted to teach her about investing, and we started by looking at companies that we interact with on a daily basis, right? So this is like a Peter Lynch way of looking at investing, things that you can draw with a crayon. This is what Peter Lynch said. You should invest only in things that you can draw with a crayon. Right now, I don't really completely believe in this idea, because you can also draw a bad business with a crayon, right? But this is something which I drew for her in terms of showing her a few companies in India. These are listed companies in India, where you have toy companies, you have cloth companies, you have paint companies, you have electric appliances, you have plywood companies, you have air conditioning, retail, food, everything out there, right? And what we did, this was in 2014. And what we did as an exercise were to pick 10 stocks from this entire list. And I asked my daughter, who was 11 years of age that time, to pick 10 stocks out of that. And these are the 10 stocks that she picked at that point of time. So this is just a dummy portfolio I've been maintaining from that time based on her stock picks. And she was 11 years of age. May 15 to May 24, that portfolio has returned at 270% point to point, compared to the Indian stock market index of 200%, and a Indian Sensex, which is a collection of the 30 biggest stocks in the country, which is given 174%. So my daughter has beaten the index starting when she was 11 years of age. And I have maintained this portfolio for long, in the sense that every time I talk, I show this portfolio of how someone without any knowledge can beat the market, right? But is this true? This is not true. There's something called the Dunning-Krueger effect. The Dunning-Krueger effect, named after the people who actually created that effect, was, it simply says that the less competent we are, the more confident we are, right? And it applies to everything, including investing. When you see the youngsters starting out in investing, and especially if it's a rising market, they start to think that it's their skill that is causing them to make a lot of money. It's not the skill, right? Probably you're getting lucky. And I'm going to talk about a lot about luck versus skill investing. Investing is not only a game of skill, it's also largely a game of luck. But people forget, because they suffer from what is known as the Dunning-Krueger effect. It applies to drivers, young drivers. It applies to any young people who are starting out into an activity. We start to believe that we know everything. But as time progresses, as we gain experience, as we meet accidents in the stock market or otherwise in life as well, we realize there is so much more to know, right? And I also talk about the island of knowledge surrounded by a sea of ignorance. Imagine you are on an island, and that island is what all knowledge you have accumulated in your life. And everywhere around you is a sea of ignorance. What happens when the size of the island grows, which means you know more and more? When the size of the island of knowledge increases, so does the shore of ignorance, which means the more you know, the more there is to know, right? So this is a handy mental model to always keep in mind when you are starting out something, that you know everything. Because the wisest man in the world ever, Socrates, said that I am the wisest man because I know that I know nothing, right? There's something called the shop of knowledge, right? So there's a story about, I'm not sure whether it's true or not, but there's a story about a famous physicist called Max Planck in Germany in the early 1900, and Max Planck won the Nobel Prize for quantum mechanics, 1914 or something like that. And he was traveling all around. Am I clearly audible at the end, at the back rows? Yeah. So Max Planck was touring all Germany, around Germany, giving lectures on quantum mechanics, right? And people are applauding, okay, the greatest physicist of our times is talking about quantum mechanics. And he's given the same lecture again and again, different universities and different places. And he was always accompanied by his chauffeur, right? So chauffeur used to drive him across, and chauffeur was also a part of the audience in all the lectures. After around 10-15 lectures across different German cities, the chauffeur said, Mr. Planck, I think you must be tired talking about the same thing again and again. In Munich, let me give the lecture. And you wear the shopper hat and you sit in the front row because nobody's going to recognize. There was no social media. So across cities, nobody recognized who the shopper was and who Max Planck was. So at Munich, the shopper was at the stage, and Max Planck was sitting wearing a shopper dress and shopper uniform and cap. At the end of the lecture, and he gave a perfect lecture, the shopper. At the end of the lecture, someone raised his hand and asked a question. Now, what happens when someone asks a question on quantum mechanics to a shopper? Now, the shopper was very smart. He said, how can someone in a big city like Munich ask such a dumb question, something that even my shopper can answer? Right? And the shopper answered it because shopper was Max Planck. So in life and investing, we have two kinds of knowledge. One is Planck knowledge, the other is shopper knowledge. Right? A lot of times, especially when we are starting out, we have shopper knowledge, which means, as Feynman said, there's a difference between knowing something and knowing the name of something. So a lot of times we know names of a lot of things, investing, stock market, right, arbitrage, derivatives, futures and options, but we don't understand what that thing really means and what are the risks embedded in that thing, right? So it's very important for us to understand, do we have Max Planck knowledge or shopper knowledge? And if you suffer from the Dunning-Krueger effect, which I showed in the previous slide, right, most of the time you have shopper knowledge. So get over that. As humanity, we are getting smarter. This is the IQ chart of humanity since 1909 to 2013, right? If IQ, of course, it was not zero, but if the base was zero in 1909, we have accumulated 30 more points in terms of intelligence as human population, human civilization. So certainly we're getting smarter, and I'm sure you're looking at people around you, you're looking at your new generation, right? The kids are smarter than the parents, and then the kids are even smarter than the parents, right? That is how we are progressing as humanity. So we're getting smarter. But when it comes to investment horizons, right? Now these are not skyscrapers, these are investment horizons. So in 1960, the average holding period of a stock in New York Stock Exchange was 8 years, right? In 2020, it came down to 6 months, right? So while people are getting smarter, while we know that compounding works in the long run, people on an average are not willing to hold on to their stocks and investments for beyond 6 months. And I think 6 months is a very optimistic number. Now people buy in the morning, sell in the evening and say long term. And this is what happens for for a very large proportion of people. They're not even willing to buy for a few hours and they say, I think it's too long term, let me sell, right? This is what causes a difference between people who actually do really well over the long term and not. The chart, the line, the bar that you don't see, this is the only advantage that you and me have as investors in the stock market, because everyone else is doing 6 months or 3 months. How do you create an advantage? How do you really do well? How do you survive the stock market over 20, 30, 40 years? How did Warren Buffett do it? One of the secrets was that he started when he was 11. Now, if you've missed that opportunity, right, you don't need to go back. You cannot go back at 11 and start investing. But the most underrated skill of Buffett or Charlie Munger or any Howard Marks or any of the good investors you see in this room or around, right, it's because they did not interrupt the compounding machine. They bought early, they kept buying, and they just stuck on to where they invest. Of course, you also need to buy good investments to stick on for a long period of time. And it does not require a high IQ. As Buffett says, investing is not a game where a guy with 160 IQ beats a guy with 130 IQ. Once you have ordinary intelligence, what you need is a temperament to control the urges that get other people into trouble in investing. So all you need to do, once you have basic IQ, all you need to do is to control the temperament, control the emotional urges to buy, sell, trade, speculate, right? Buy bad businesses, invest only because the stock prices are rising, sell because the stock prices are falling, invest because someone else in your family or friend has advised you, probably Hari advises you, right? And you buy just because Hari is advising, Hari is buying, it doesn't mean that you should buy and you're going to make a lot of money. Probably he's making a mistake, right? And if you follow him blindly, you're also going to make a mistake, right? So have you heard of a guy called Mohnish Pabrai? Some of you. So Mohnish Pabrai is one of the best investors we have in the current times. And all he did, according to him, is that he copied Warren Buffett. Whatever Buffett used to buy, he applied his brains, of course. And he made those 1 or 2 decisions every year. And this is how he created a lot of wealth for himself and his clients, just by copying Warren Buffett. Right? Now, that copying also requires intelligence. You simply cannot cut, copy, paste. You need to understand whether you understand the stock or the business or not, whether you understand the business or not, whether the person whom you're copying, is he making a mistake or not. Right? So we need to understand all those things. And as Buffett says, for that you require ordinary intelligence. And beyond that, it's largely about temperament. Now, what makes investing bulletproof? Bulletproof in the sense, right? Of course, there are going to be a lot of bullets coming at you in terms of market cycles, bad markets, right? Economic slowdowns, depression, epidemics. Now we've seen. I mean, markets are going to go through very terrible cycles across over the next 10, 15, 20 years. And I'm sure a lot of people who've been investing, they have had experience of such kind of cycles and such kind of market environments. Now, how do you protect yourself against that? The 3 ideas, and I'm sure this is not related to investing at all, the 3 ideas that we've learned as we've grown up is patience, humility, and rationality. And this is the core of what I'm going to talk about in today's session. Everything that I'm going to talk about today's session is going to revolve around patience, humility, and rationality. Let's start with patience. Emerson, adopt the pace of nature. Her secret is patience, right? We've been taught to be patient while driving a car, while investing in the stock markets, with people, right? Just be patient. This is what our parents and grandparents have already taught us, right? But when it comes to stock market, something happens, right? The same patience that we are able to apply in ordinary life, we lose it all when it comes to stock market because everyone else is impatient. So how can I keep myself patient, right? Look at this data. Now, this is data from the US markets. I think similar numbers apply to all kind of markets with long history. Multiple recessions, right? So this is the number, the amount of correction, right, in the next 1 year, I think, which happened after every recession or a crisis or a war or a shock, right, or a crash or a war, Asian crisis you had, right? This is where I think the Thai economy had the biggest hit, right? Tech bubble, COVID pandemic. In the next 1 year, I think few months, if I don't remember, I think the impact on the stock market was on an average 32%. The stocks on an average fell by 32%. But 5 years plus from that event, the markets on an average were more than double. Now, there's no guarantee. It does not mean that every time the markets fall by 30%, they are bound to rise by 123 or 150% in the next 5 years. But investing is all about probabilities. There's no certainty. Even if you buy the best of business, you can still lose a lot of money. And if you buy the worst of business, you can still end up making a lot of money, right? And that's the reason it makes investing a game of luck and not skill. There's a wonderful book called The Success Equation by Michael Mauboussin, where he's laid out activities from pure luck to pure skill. So activities that involve pure skill, and those activities are like individual sports like chess, or you have team sports like football, basketball. And on the extreme right hand side, where you have pure luck activities, those are activities which are like gambling, which are like stock markets. And he says the way to differentiate between pure luck and pure skill is that if you can lose on purpose, that's a game of skill. And if you cannot lose on purpose, that's a game of luck. Can you lose on purpose in chess? Of course, if you want to lose, you can lose. It's an individual sport. Can you lose on purpose in football? You can. A bit difficult because you have to get your team agree to that fact that you want to lose this match, right? But can you lose on purpose in stock market? You cannot. If you made up your mind that today I'm going to buy the worst stock in the market so that I lose money, by the end of the day, you are up 10%. Because you don't control it. Right? And if you think that whatever you buy is going to turn to gold, you don't control it. You made the best investment, you bought the best stock available in the market, and it's down 10%. And now I'm not talking about one day. Even in 5 years, the stock has not gone anywhere. There's so many experiences. I'm sure people who are investors here have had experiences where they think that 5 years back, I made a good decision. I bought a great stock. The stock is not doing anything. If you want to make the stock do something, just sell it. And that is where the stock starts rising. Jeff Bezos understands this idea of patience very well, right? And this is what he says multiple times, that if everything that you do and you want the results in the next 3 years, then you are thinking like everyone else. But if you're looking at a 7 to 10 year time horizon, which means the efforts that you're making now, and you want them to bear fruits over the next 5 years, 7 years, 10 years, then you are thinking unlike others, right? And Bezos also said that things are going to happen, right? Things that deserve to happen are going to happen. It's going to take a lot of long time. Do you have that kind of time or not? In the stock market, nothing may happen in the next 3 to 5 years. But by the way, compounding works. If you have made the right investment, if you had the right temperament, if you don't interrupt that compounding machine for the next 10 years, 15 years, 20 years, and the longer your time horizon and the better the investment, you are going to create wealth from stock markets over a long period of time, right? And this is how you differentiate yourself from most other people. I'm not sure if you've read this wonderful book, What I Learned About Investing from Darwin, written by Pulak Prasad, who's a money manager from Nalanda Capital based out of Singapore. And they are the guys who are one of the rare investment team in the industry who buy and don't sell at all, right? And they have sold some of the stocks, but this is the list of 22 companies. They've not named the companies. One of the members of Nalanda Capital is Anand Sridharan, and Anand actually writes a wonderful blog called Buggy Human. And in one of the blogs, I think last year or a couple of years back, he did, without naming the name of companies, he just shared the track record of each of these stocks, 22 companies that they bought in 2012 and did not sell for the next 10 years. And the returns on an average were between 18% to 43% compounded annual rate of return for these 22 stocks, which they did not sell at all in the previous 10 years. During the same period, the Indian markets, because these are Indian companies, the Indian markets returned 12 to 15% annual average return just by doing nothing. And this is what Anand wrote in his article. Over a decade where most investors struggle to beat index, total inactivity would have delivered top decile performance. Had God revealed this future in June 2012, I would have cancelled Bloomberg and completed my bestseller, Indolent Investing, from a nice beach. The only condition, he says, to realize all this awesomeness is we do almost absolutely nothing. Nothing. We equate stock market with activity. This is what we think. Stock market, if you are going to be a stock market investor, you should be looking at the stock screens on a daily basis. You should be looking at stock prices on a daily basis. This is, I'm sure people in this room don't believe in that thing, but this is what the general audience believes in, that if you are going to be a good investor, you should be very active in the stock market. But if you look at the best investors out there, over multiple decades, I'm not talking about the last 10 years, but over multiple decades, these are those investors who have been in the stock market, but most of the time they have not done anything. They have bought great investments. They have held on to those great investments over a long period of time. That is what has created the most amount of wealth for those investors. The problem is that we are not willing to learn from that because that sounds so simple, right? If you go to a doctor, and this is how we behave. If you go to a doctor and you are suffering from some mild flu and some cold, and the doctor says, do nothing, go home, sip warm water, relax, no medicines. And he says, I want $500, right, as my fee. And you say, for what? You've done nothing. On the other hand, if a doctor gives you an antibiotic, a painkiller, right, a medicine, 5 or 6 different medicines, then you think that the doctor deserves a $500 fees, right? Because we equate activity with achievement. In medicine, it happens, right? You go to a doctor for something, and probably the next day you're on the operation table because the doctor has to justify his fees or her fees by acting on things. Whether it's healthcare, whether it's investing, the less active you are, the better off you're going to be over a long period of time. And this is what Nalanda's Capital, Pulak Prasad that I was talking about, approach to investing. 3 things. Avoid big risks, which means don't invest in something that can kill you. The second is buy high quality at a fair price, which means always focus on high quality investments. And the third thing is don't be lazy, be very lazy, right? This is what his team did. 10 years, 22 stocks, no selling, just they bought those stocks and did not do anything. And they outperformed the markets by a far margin. Of course, one of the reasons is that you need to buy high quality. You cannot just buy anything and think, okay, I'll not do anything. I'll retire on the beach after 10 years. Nothing remains. You have to buy high quality. That's the first thing. Equanimity. Now, how many of you like philosophy? Very few people. Right? I talk a lot about philosophy, and I'm sure you must have understood by that. It's less about investing and more about how to become a good decision maker and how to live a peaceful life. Right? So in Gita, in Indian philosophy, there's a concept called samatvam, which is sameness of the mind. Sameness of the mind, and this is what Rudyard Kipling also says, right? When the world is going topsy-turvy, if you can maintain yourself, maintain your mind as calm and composed, you'll be a man, my son. Right? This is what he said. Triumphs and disasters, they're two imposters. Right? Bull markets and bear markets, they're two imposters. They're in front of us on a daily basis. But how do you survive the markets up and downs? How do you survive the good and the bad cycles over 20, 30 years? By maintaining evenness of mind. There's a story about the king who sent his courtier to find those 3 or 4 words that are true across, or a sentence that is true across all life situations. And that courtier roams around the country, meets the wisest people around, and comes up with 4 words which are true across all situations. And that sentence is, these too shall pass. Everything passes, right? In stock markets, you have bear markets, you have bull markets, you have bull markets, you have bear markets. Everything passes. And this is how, if you really believe that over a long period of time, if you can keep yourself, if you keep your mind sane, right, and same, right, you're going to do really well. You're going to survive. Investing is not a finite game, right? Now, there's another concept of finite versus infinite games that we play. What are finite games? As the name suggests, those are the games which have an ending, right? A game of football, a game of cricket, for example. But then, okay, one company, one product kind of a stuff. And he used it to explain that if you buy good quality business at any time, you can make a lot of money. And this is what we understand, right? Investing is about buying high quality businesses. This is what I'm talking about as well. You could make a lot of money, right? This, by the way, is the stock price chart of Microsoft. During 17 years, from December 99, which is the peak of the dot-com, nearly the peak of the dot-com boom, for the next 17 years, investors in Microsoft who held onto the stock earned nothing. Where is long term? Now, one excuse to this argument is that, of course, there would be very rare number of people who would have bought at the peak and held on for 17 years. Most of them would have sold here or here or here, right? Nobody holds on to stocks, especially when they're not giving any return for 17 years, especially when you're losing money. But even if you've held for long term, 17 years, you would have not made a single dollar, single percentage of money in a high quality business like Microsoft. Long term, right? And then this happens. Now, this is that long term. When 17 years you lose hope, you don't make anything. And then in the next 4-5 years, you make a 16% annual average return from here till here. So this is 16%. It happens in the last 5 years. Now, how do you know? When is that cycle going to turn? When is that long term going to end and you're going to really make money in the stock markets? How do you know? Even if you're the most diligent of investor, how do you know? And Microsoft has been a great business. Of course, the reason of buying Microsoft in 1998, 99 was different. It was Windows software. They lost the plot in tablets, in smartphones, everywhere they lost the plot. And when they got the plot right, this is what happened. But how do you know whether you should be buying Microsoft more, you should be selling Microsoft, you should be holding Microsoft, and you should be not doing anything and probably buying here to see the rise, because this is a huge rise, huge wealth created by Microsoft in the last 5 years. And even if you were an owner of the stock from this peak till now, you would have earned a 16-17% annual average return, which is a great return over 24, 25 years of not doing anything. Now, how do you know that you should have not owned Microsoft, and buying reasons for buying Microsoft here was very different from here? This is what is all about process. How do you look at investments? How do you look at businesses? Right? Again, in Gita, there's a saying called karm karo phal ki chinta mat karo. Karm is action. Phal is the fruit. Right? Do you control the fruit? Do we control the outcomes? The Gita says no, we don't control the outcomes. But do we have some control on the karma or the action? Of course, we have a lot of control on the karma and the action. Right? So if we can apply the same rule which was said by Bhagwan Krishna to Arjuna on the battle of Mahabharata centuries and centuries back, And the same rule apply to investing as well. All you control is the process, you don't control the outcome. Right? If you have a good process, you will have a good outcome in the long run. If you have a good process, you may have a bad outcome. That's a bad break. If you have a bad process, you can still have a good outcome in the short run. That's dumb luck. And if you have a bad process, in the long term, you will have a bad outcome. So all you need to focus on is a good process, then expect to be deserving to receive a good outcome in the long run. And investing, as I mentioned, is not just a game of skill. Knowing how to read financial statements, picking the best kind of investments, it's not entirely that investing is all about. Investing is also largely a game of luck. Right? As Buffett says, he won the ovarian lottery to be born in the United States at that point of time. We probably all won the ovarian lottery to be able to afford to invest. And not born in a country where there's no stock market, or probably there's war and strife and everything. So now that's not your skill. That's your luck. Or probably I started investing in 2003. This is where I got my first job, straight out of college. And that was the start of the bull run, the best bull market India has ever seen between 2003 and 2008. The stock market as a whole multiplied by 7 times in that 5-year period. And by the 5th year, if you're an analyst like me in the stock market and everything is rising, you start thinking that you are a master of the universe. Everything you research, everything that you recommend as a stock turns to gold. You think you know everything. Because that time you don't know about the Dunning-Krueger effect. And you don't know about the Planck's knowledge versus Schoffer knowledge. In hindsight, you know all those kind of things. But we all suffer from the syndrome of not giving luck its due credit, like this person who won the Spanish national lottery somewhere around 2001, 2003. And he won 1 or 2 million euros in the Spanish national lottery. And when you win a lottery, which is the biggest lottery in the world, you're going to get interviewed by newspaper and media. People think that you are smart. And people were asking this guy a question, okay, how did you manage to win such kind of a lottery? And as if he knew the secret. And this guy knew the secret. And they realized that this guy was looking for a ticket, lottery ticket with the last 2 digits as 48. Of course, this is not the actual ticket. I found a ticket with the last 2 digits as 48. And they asked him, why were you looking to buy a lottery ticket with the last 2 digits 48? You bought the lottery ticket, you won the lottery ticket. What's the secret? And he said, I wanted to buy the last 2 digits 48 because for the previous 7 nights before buying the ticket, I saw the number 7 in my dreams, and 7 into 7 is 48. I went and bought the ticket. Isn't that my skill? In stock markets, we behave the same way. We think 7 into 7 is 48. And when we actually get 48, we think it was our skill. Not realizing that it was pure luck. That 7 into 7 turned out to be 48. And you got lucky. Because I have stopped eating that sugar many years down the line. And it has benefited me. And I'm sure a lot of you are also not consuming the same sugar that I've talked about. Right? So wherever you're consuming more sugar in your life, whether it comes to investing or decision making or thinking, the idea of today's session was to guide you to stop doing that. Because over a long period of time, if you behave irrationally, if you're impatient, if you're not humble and you're arrogant, right, it's going to kill you financially otherwise. So with that, I come to the end of my session. I'll be happy to take any questions. I hope you found it worth of your